To CNBC TV18's Mumbai newsroom, I'm Sumaira Abdi and you're watching MF Corner. Today we have Santosh Joseph, founder and partner at Germinate Investor Services LLP, who's going to talk about, where the money from equity mutual funds is going. Because if you look at it over the last few months, the inflows into equity mutual funds have almost become 1/3 of what they were even say as far back as April, right? So what is the reason? Is it that investors fear that there is a lot more volatility which is ahead, or are there other reasons for it? Santosh, thanks very much for joining in. So my first question to you is just this, markets are volatile naturally, but inflows into equity funds are dipping. Is it that investors are once again fearing volatility? And because there what happens is that, by the time they get back into the market would have already, rallied. So they end up missing, by trying to time it, they end up missing the essence of remaining invested. So what is the reason? Is it that investors are worried, or is there more to it?
Well, I think you said the most obvious point in the question itself is the heightened volatility. And then you should look at it from the recent past. 2021 year was a fabulous year. People made 30, 40, 50% return depending on which product you invested. Getting into 2022, we began the year with a lot of negativity, which is we were worried about the new Omicron variant of the COVID virus. Just when that fear was settling in, then you had the massive FI selling numbers that kept pouring in month after month. While we were settling with that, you had the Russia-Ukraine war. So you see, it's just not normal volatility. This is heightened volatility. Now, for an investor, this heightened volatility is not conducive for him to bring in more money from his wallet share. They want to wait to see a subdued effect. Now, while the Omicron, the Russia-Ukraine war, and you had the FI selling happening, you saw the second-order effects of the war situation, which is oil price shot up, inflation shot up. Now, to control inflation globally, all governments and central bankers started, maybe since April, May, started rising interest rates. Now, this has made a massive roller coaster out of the markets where people do not like that. They like markets to be calm. They like the markets to be more or less buoyant, more bullish outlook. And, we cannot ignore the sentiment. People like good, positive sentiment to bring in more money from their pockets to be into the markets. So volatility, if you measure from what we've seen in 2021 and a great second half of 2020, as far as equity markets are concerned, 2022 has literally put some bit of fear in investors' minds. And therefore, many of them are holding back or figuring out how to play the market in maybe different ways, and which maybe we'll discuss during the course of this interview.
Okay, so let's talk about exactly that, Santosh. There is money which is flowing in. So where is this money going?
First things first, it's not that investors are not coming into equity. They are coming into equity, just that the approach has changed. In fact, when we look at the AMFI numbers that has just come out recently on the mutual fund sales, hybrid equity sales, or even SIP sales, one is looking at these numbers and saying, are we losing flows or money is going out? Actually, the answer is no. Investors are finding more avenues and more methods to participate in equity. So they are coming as more direct investors, which is entering into the stock market directly through a broking channel or through a DIY platform where they are able to open their own demat account and start. Now, if you look at the context, let me put a very interesting number over here. You have today most amount of demat accounts ever in our history, and over 50% of that has come in just last 2 odd years. The COVID pandemic brought in so many disruptions, and one of the disruption is the equity-oriented culture in India. So March 2020, you had little over 4 crores of demat accounts, and as we speak today, I think the number is little over 11 crores. Now, that's a massive 2x jump in terms of the sheer number of demat account holders, which means these people are participating in equity, but in a direct format. So on one hand, you're asking, were you worried because mutual funds are having subdued flows? On the other hand, the market itself is becoming more buoyant because of more direct participation through demat accounts. And that's a very good headline number for us to realize that equity is not losing sheen. Maybe the product that people were extremely comfortable with is now maybe second order or third order in priority in the way people access equities.
But Santosh, you mentioned this, that, there are other avenues that people are looking to invest from. Is it that the, proliferation of these PMS or AIF sort of funds, is that what is cannibalizing the mutual fund market?
That's one of the first things. For example, over the last 3 to 4 years, we've seen many star fund managers quit and start their own boutique PMS and AIF. Now, that is the organized business. The unorganized business, in so to speak, to enter equity, is being the many online channel platforms that give you access to buying and selling equity, where you don't need a broker, where when you're not sure what to buy, what to sell. So on one side, on a very well-regulated platform like PMS and AIF, you have star fund managers who investors know are coming and offering solutions at a differentiated level or maybe slightly more higher up the value. Money is going over there. Now let's also pause to just look at the sheer numbers. The PMS and AIF industry is growing at a maybe double, triple the rate at what mutual funds are growing. And you just look at the number of players. Even now, the mutual fund players are between 45 to 50. Whereas the PMS players are officially maybe more than 600 or 700 of them. Now, the competition is really starkly different over there, because mutual fund were catering to one segment of investors. The PMS guys are catering to largely the mutual fund guys who are scaling up, who are willing to put the minimum 50 lakh ticket size or a 100 lakh ticket size to move up the ladder by investing in a boutique PMS or a boutique AIF. In fact, in 2021 calendar year, the top 5 PMS providers and the top 10 PMS providers, you just were to take an aggregate value, they've collected more than 12,500 crores. Now, you could say some bit of it is new money, but you should also understand largely this bit of money would have otherwise gone into a mutual fund scheme, which is now moving into PMS and alternates.
Yeah, absolutely. But PMS, AIF, these are still funds, right, which are run by somebody else. Is direct buying of stocks also equally to blame?
Absolutely. So let's use that simple number. You just take the year 2022, the number of Demat accounts that we're opening month on month. Between February, March, April, May, those 3-4 months, you had massive uptick in the number of Demat accounts because of the LIC IPO. The whole world went gaga over the LIC IPO, and every retail investor wanted to have a Demat account ready to be participating in the LIC IPO. Now that tells you that the Indian retail investor is come of age in terms of participating directly in an IPO, participating directly in equity, participating directly in terms of what stock he wants to own, rather than a mutual fund or even a PMS route. Now, when you see this trend, you also have to understand that this is backed by the massive growth of fintech enabled digital platforms, which not only gives you the ability to buy and sell or hold a Demat account completely online, they also give you solutions. The small basket solution saying which are the top 4 stocks, 5 stocks, 10 stocks based on various strategies at a very small fee. And people like to take control of it. They like to experiment. They like to, taste a little bit of risk. They have also, have a lot of time on hand since the pandemic and work from home scenarios happened. We have a lot more digitally enabled investors today than ever before. Like you see the growth of the Demat accounts, you also have seen growth of trading accounts. Now, growth of Demat and growth of trading tells you more number of direct investors wanting to take a shot at equity markets themselves.
Okay. Santosh, there's more that we want to talk about, but on the other side. For now, let's take a very quick break. Santosh stays on with us and we'll be right back. With MF Corner, and with us is Santosh Joseph, who's a founder and partner at Germinate Investor Services. And we've been talking about, what's happening to flows within equity mutual funds, why they're tapering off, and where is that money going. So far we have spoken about, that money into equities seems to be intact. It is just that where it is allocated between mutual funds, other platforms like PMS, AIF, etc., or even into direct stocks, that distribution is what is changing. So Santosh, we've spoken about, the equity market, but is some money from the equity market itself getting diverted outside, say into housing, for example?
Well, the money within equity is intact, and I think many have alluded to the fact that retail investors saving the day, especially when you had so much of FI pulling out of happening. Retail money was there, so though you didn't see it in mutual fund, it was coming in various corners. Now, like we spoke about the pandemic-led disruption that has distorted or changed so much of the natural order. There are many other avenues that an investor is now looking at as his investing pattern. One is real estate, the other one is the auto sector. Now, when you look at the auto sector numbers, specifically the last 2-3 days, I'm sure almost everyone is seeing at the phenomenal numbers that the two-wheeler and the four-wheeler companies are putting out. So when you look at that, you'll notice that car numbers are phenomenal. The wait times for car is such a long period of time. Now, this has also come from the fact that you only live once, so therefore you don't know when another pandemic will come. Let me get my good car that I want. Or even housing. Now you see phenomenal demand for housing because people now know if I'm going to work from home, I want a better quality home, a bigger home. Now, a need for a home, a need for a car is all pent-up demand coming out of COVID. Also because there's a need for it right now. People want to have their own automobile. People want to have a better quality home. So actually, real estate and automobile sector are fighting for the same wallet share of an investor that normally would have come into some of the managed equity solutions. So it's just not within the product. There's a shuffle. There's also a little bit of other competition from outside where investor wants to take that decision of buying a slightly bigger home or a newer home or even a newer car.
And it's not just equity, right, Santosh? Because even in on the debt side, we're seeing that not all monies are coming into debt mutual funds, right? Where is that money going?
Oh, that's a good point that you made, because in fixed income post March 2020, and you had one AMC go through that challenge of the credit risk funds and the long duration funds. If you notice that between April, May 2020, the short term and the liquid fund yields fell to below 4%. Now, an investor never saw any value in investing money in fixed income for sub 4% kind of return. On the other hand, thanks to the growth of fintech platforms, you were able to buy bonds directly on your own, like you buy equity. And you also had some AIFs come with aggressive credit funds, which gave them that maybe 7, 8 or 8.5% kind of a yield, which investors were happy to park their money with. While this was happening, you also saw in the last 2-3 years that you had 1 or 2 REITs and InvITs come out where it gave you a proxy to a fixed income investment. Now, let me also share something with you that when you looked at the credit space before March 2020, it was a massive space, maybe 40,000-50,000 crores. Post the credit risk issue that we had, that space shrunk to maybe about 10,000 crores, where there was a flight of money away from credit risk, flight of money away from fixed income, fresh money is coming in at stock. So therefore, this money was getting into, let's say, maybe an InvIT or a REIT or direct bonds or specialized structures of AIFs offered, which was for the discerning investor who understood the risk involved. They were taking a call in AIFs.
Okay. But, Santosh, whether it's equity or debt, I mean, like you've highlighted that there are now many options which are available for retail investors. But, for somebody who's watching right now, what would you rate in terms of your preference? Where would you recommend that long-term monies be parked?
See, today I think an investor is spoiled for choice, and I think we should be happy with it, right? There's PMS, there's AIF, there's direct buying, there is platform for bond, and then there is our good old trusted friend, the mutual fund. Now, in my personal opinion, that if an investor is new and if an investor is trying to make the most of the markets, mutual funds still offer one of the most simplistic, fantastic tool to be present in. Now, when people ask me, Santosh, why a mutual fund over PMS or AIF? Number one is the ticket size. Number two is just the process of it. For example, in a mutual fund, when you buy and sell, only then you come across the whole capital deal thing. Whereas in a PMS, you have to pay capital gain, even though your money is not out and you need a minimum 50 lakh ticket size. There's a lot more paperwork to be done. And of course, when you're writing out a check for 50 lakhs, you may want to know the due diligence of the firm, though they're all very well regulated. All this cannot take away the fact that still, by and large, mutual funds score phenomenally high in terms of the product the access to markets and the diversity of the products and the bouquet of services are phenomenal. For a retail investor to consider, I think there's a great tool, and it will continue to be great for a long period of time.
All right, Santosh, thanks very much for joining in. And, just for me to add my 2 bits at the end, which is that, our mutual fund is one of the most highly regulated and transparent vehicles which is available today. And for anybody who's looking to, choose different platforms by all means. But if you're looking to divert money from mutual funds, please do make sure that you have done enough due diligence because, for long periods of time, it does remain one of the most trusted vehicles for investment. So with that, we're going to wind up on this show for today. But do remember, you can keep sending us all your queries or topics that you'd like for us to discuss, and we'll take them up with our experts through the week. For now, we'll leave you with some market opinion. Comes in from another mutual fund manager, Taher, Badshah, CIO of Equities at Invesco Mutual Fund. And do stay tuned. The team of Closing Bell will join you next.
There's been a fair bit of interest rate highs that we've seen in the system, but concomitantly we've not really seen as much of inflation decline come along with it, especially as far as the developed markets are concerned. So to my mind, I think while there is a growing clamor from different parts to kind of slow down in terms of rate hikes, etc., and give the economy a little bit of chance, we've seen deposit growth trail credit growth for a fair bit now, and that is something which probably is something to be watched out, at least as far as the profitability of the banks is concerned. So I think barring that, I think we are reasonably fine as far as the financial sector is concerned. Even though I kind of worry at the margin that our rate cycle might probably incrementally is looking like being a little higher than what we started off believing 6 months or maybe at the start of the year. So that risk apart, I think more or less the banking sector looks fine to me. We know that there is under-penetration, especially in some of the segments of the auto market. It's also a sector which is reasonably well placed from a cyclical standpoint, but very tactically, I think it has done a little bit of stuff that it was that was expected out of it at the start of the calendar year, or maybe towards the end of last year. And to that extent, this is a market, as you know, we've had some very ruthless sector rotation and churn in very short periods of time. And, it cannot be a surprise if we are probably poised for another kind of sector rotation. And in that regard, we've seen some of the performance come out of the sector, and maybe we have also seen some good numbers come up pre-festive season demand. We've had this bent towards domestic stories for a reasonably good length of time now, since the start of this year or maybe last year, and that's playing out pretty well. And it still has a fair bit of legs because we will see decent amount of earnings growth come about. But they've also been equally rewarded during the course of the year. And just out of sheer sector rotation and the fact that at the margin, it looks like India's terminal rate may not probably be as much as, it could be higher than what we probably initially thought, like as mentioned earlier. And if that were to happen, then some bit of, in the season of rotation, I would not be surprised if we see some rotation out of some of the domestic sectors into some of the other defensives or maybe even global sectors, steadily turning into a value opportunity. We don't really have a reason to significantly rush in as far as the IT sector is concerned. But I view it more like a counter-intuitive play. at the end of last year, when most companies were indicating at reasonably good trends and continuing strength in commentaries, I think that was a time when probably things were looking relatively tougher for the sector as such. And now we are seeing some giveaways in terms of softening in the sector, and maybe probably counterintuitively this might probably be the time to actually look at this sector more constructively, at least from a medium-term perspective, if not the next 2 quarters.